I'd love the listenership to kind of get a 101 banking overview.
Banks are leverage plays on economies. So if you think of a national bank, it's a leverage play on the national economy. So as the U.S. economy does well, the bank will generally do better, and as the economy goes into recession, the bank will have trouble.
Well, I'd like to welcome everybody to Buchanan's Counting Capital Podcast. I'm Robert Brunswick, Chairman of Buchanan Street Partners. And today it's my great pleasure to have my friend Eric Hovde, Chairman and CEO of Sunwest Bank, as our guest. My goal in having Eric join us today was to really have him unpack a bit of the world of banking for us through his unique vantage point as the owner of Sunwest Bank. I met Eric and his wife Sharon years ago, as both our families have shared a passion for Airedale Terriers. So we hit it off very quickly. Eric's got a very rich and diversified set of business and life experiences that I'm sure will enhance his views in our discussion today on the business of banking. So let's get to know Eric and have a conversation here together. Eric, I'd like you to tell us a little bit about your life prior to your business career. And really what I like to do with my guests is have them lean in a bit to their upbringing and maybe its contribution to your role today in business and moreover as the chairman and CEO of Sunwest Bank.
Sure. Well, first of all, I'm a fourth generation Wisconsinite. I guess you called me a cheesehead, diehard Packer fan, been to Lambeau many, many times. So, and UW Badger fan. So born and raised in Madison, Wisconsin. I'm the fourth out of five kids. We're Norwegian by background. Hovde means head of the mountain. And literally the Hovde farm is outside of Voss, Norway at the head of a mountain. My father's father immigrated off that top of the mountain in early 1900s, and my great-grandparents came with five kids, my great-grandmother pregnant, all the way to off that mountain, all the way to America. It's a farm in South Dakota, and then finally settled in Wisconsin. I always can't believe, I don't know how they got them off the top of the mountain, five little kids, and then boats, and then a train up through Canada and wagon train, and living on literally a farm, and they lived in a one-room shack with one bed, one door, one window, and somehow survived. So come from hardy stock, you could say, but then again, everybody has those wonderful stories in their background. So I was a kid, I was born in 1964, as a kid of the 60s and 70s. As I said, I was the fourth out of five kids, two older brothers, an older sister and a younger sister. Strong-willed family. My father was a dynamic business guy in real estate, became president of the National Association of Realtors, went on to serve President Reagan as number two at HUD, authorized the creation of the first mortgage-backed security. He's the only person I think ever served as the board member of Fannie Mae and Freddie Mac. So, had him as an example. I had a wonderful, loving mother that really was blessed with in my life. And then, it was just a different time in America back then. I grew up where you could run out your door at, when you're 7, 8 years old, disappear on your bike all day and nobody had to worry about you, and come home, at dinner time, or maybe have dinner at one of your friends' house and call your mom and say, I'll be home around 9 or 10 o'clock, Mom. And all the rest. So, it was a special time in America, and I was blessed to be raised in the upper Midwest. I was kind of a rebellious kid. I don't know for what reason, probably because my dad was so busy traveling and working, and, he wasn't around a lot back then. Fathers pretty much worked all the time, and he was one of those. So I was a bit of a rebellious kid, got my fair share of problems and all the rest, but largely on the straight and narrow. I got into fighting martial arts, which helped, discipline me. Was always into physical fitness, weightlifting, every kind of sport. So that's kind of my background. Grew up living on a lake for part of it, so the water was a big part of my life. Big water skier. Had a lot of friends. All in all, I had a very lucky childhood.
Yeah, well, no doubt mom and dad would be quite proud of you. I heard you say the word discipline. I think of the martial arts training and what that does for you. And as I've gotten to know you, your work ethic, your drive, your aspirations to make up for a better world is all clear, and I'm sure carried forward through that upbringing. So thank you for that. As I've gotten to know you, Eric, and known your vast experience in kind of what I would characterize as the greater capital markets, really including all types of investing. So I didn't get into your resume today because I want to focus on banking, but there's so many avenues within your resume that we could focus our podcast today on in the world of private equity. But as I think about all those experiences you had, I come back to banking and saying they must have given you some great insight into how to own and operate a bank. So talk a little bit about that collection of experiences that have really lent it you to becoming a chairman and owner of a bank.
Well, interesting enough, I first started working in an investment banking firm doing mergers and acquisitions of community banks. And when I started in it, it was, 87. And back then we had 22,000 banks in America. We had 14,000 savings banks in America. We had interstate banking laws where a bank from Wisconsin couldn't go into Illinois, and a bank from Illinois couldn't go in Wisconsin, or Florida into Georgia, or California into Arizona. So we had all these restrictions. So I was pretty young and bold and believed I could start my own firm doing this because you could just see this wave of consolidation that was getting ready to happen. In college, I had an economic major, and most of the other developed world had much lesser banking institutions, much bigger banking institutions. So interstate banking law was falling. So I saw this consolidation wave coming, and so I started my own firm. So I first started understanding banking from the standpoint how another bank values a bank, how they price it, how they assess the risk. So that taught me a lot. And then I made my first acquisition of a bank in 1994 in Clark, New Jersey. Troubled bank, savings bank, bought a 49% stake in it. And that really then started teaching me how a bank operates, internally, and all the various aspects you have to be aware of, because the banking institution is very different than most other companies. And why do I say that? Because most companies, when you create a product, you sell it, you want to sell as much of that product as possible. Well, in a bank, when you sell your product, you take it back in the form of credit risk. You're selling a loan. In a deposit, you're taking that in, obviously, as a liability, but ironically, that's really where the core value of a bank lies. But with a bank, you have something called credit risk that you generally don't see in most other companies. You have a lot of interest rate risk, so you got to match your liability and your asset structure. So being involved in turning around a bank taught me a lot. And then also about, I was already building my own investment banking company, but then I started making assessments of why this troubled bank went into trouble. And as the more banks I bought, I started learning really what creates a dynamic company and what causes companies to go off the rails. And we'll probably get into that later, but it's culture. So then I also started a hedge fund investing in the public markets of banks. and savings banks and the whole broader financial services industry and the real estate industry. So there you're looking at it purely from an outsider's perspective on how to value a company, their earnings, price to tangible book, and all these other metrics that you look at. So I've been in a very unique perspective where I was first doing investment banking, understanding how other banks valued banks, and going through that whole due diligence process, and writing, not writing contracts, but reviewing the contracts created by attorneys on how to buy and sell banks. Then I started learning how banks operate internally, owning a bank, and then I started really understanding how the public equity markets looked at banking, and the allocation of capital in and out of the banking sector, from a hedge fund standpoint. So I've been in a unique position that I've had all these different viewpoints into the banking industry.
Great frame for us. I want to come back to SunWest in a minute as to why you bought it, what they looked like when you bought it, and how do they differentiate themselves. But before I do that, let's stay with your education bit on, for a bit on the banking side. So I'd love the listenership to kind of get a 101 banking overview from you, a little bit about how are banks capitalized from an equity and debt standpoint. I think most don't know how levered they are. How do they make money? And then more importantly, which is what we've all kind of come to learn more about, is how do they manage risk, if you will, or supposed to manage risk, as we think about just that simple responsibility of a bank.
Banks are leverage plays on economies. So if you think of a national bank, it's a leverage play on the national economy. Think of Bank of America, J.P. Morgan. So as the U.S. economy does well, the bank will generally do better, and as the economy goes into recession, the bank will have trouble. Same thing with a regional bank on its region and a community bank on its local community. Because you're leveraging up the balance sheet. Typically, a bank is 15 to 1 leverage. My bank, I've always operated with a little lesser leverage. I like higher capital levels because, our two brands with SunWest Bank is the bank for entrepreneurs, built by entrepreneurs. But the second brand is the bank with the fortress balance sheet. Because when the economy goes down, banks will take credit losses, and to me, that's when I can be more aggressive and start buying problem banks or failed banks, which I've done a lot in my life, and continue to lend and take care of my customers. Because every customer knows that they've been there at a point in time, if you've been in business long enough, where the economy goes down, the bank starts getting in trouble, and then they start trying to shrink their balance sheet and get their capital levels up because they're probably losing money, so they start pushing out customers.
And Eric, just 1 second, I want to make sure we capture this. That 15 to 1 leverage, where is that leverage coming from if you kind of broke that down?
Okay, so when you think of it, let's get to how a bank operates. A bank brings in deposits. It funds itself through deposits, and it can be, checking accounts, demand deposits, money market accounts, CDs, or it can do it through borrowings. Borrowing from the Fed, but most likely most banks will be from the Federal Home Loan Bank system, where they'll borrow money. Then they take that money that they have, they invest that or lend that back out. So they make it, in loans. So you got C&I loans. Those are, think of it, business loans. You have real estate loans. It could be commercial real estate loans. And, from industrial to office to multifamily, you name it. It could be residential real estate loans. Then you have consumer credit. Think credit cards, or any kind of personal loans. Auto would wrap into that. Or they can invest it in treasuries, in mortgage-backed securities, in corporate bond markets, the muni markets. So how a bank makes its money is largely the margin they generate between the cost of their funds and the yields they get on their assets. Now, it's very important that when you're running a bank, that both when you lend and make a loan or make an investment, that you're guaranteeing you're going to get paid back, because if you don't get paid back, you're taking credit losses, and that loss goes right to your bottom line, both in your earnings and then obviously an impact to your capital structure. So, or the other issue, which we had last year with the failure of Silicon Valley Bank Corp and First Republic, they took an enormous amount of what is called interest rate risk. They broke one of the two cardinal sins of banking, which is they're borrowing short. And when I say borrowing short, I mean they're taking deposits, because people can come, unless it's a long-term CD, they can come take the deposit out of the bank at any given moment. And they, in the case of Silicon Valley, invested long in mortgage-backed securities when mortgage-backed securities and interest rates were very low, because they made all these investments in end of '00 and '01 when interest rates were rock bottom. So then when rates started to rise, their holdings of their mortgage-backed securities went massively underwater, and their funding costs came up, so their margins were getting collapsed, and they were taking sizable losses, and then they had a run on the bank where depositors pulled their money. And in First Republic's case, they were doing the same thing, except instead of investing long with mortgage-backed securities, they were lending long with mortgages, single-family mortgages, at a 30-year duration, largely in the jumbo market. So again, back to the banks. They make their money on spread. There's also fee income that they generate. And a lot of banks have tried to find other niches where they can make money that's not just off their balance sheet, but just other business lines that may, be part of the banking infrastructure. If you look at any of the big banks like Wells Fargo or Bank of America, they do a variety of different other services where they can make fee income off of. And that's the same thing with Sunwest. We have other different business lines that aren't totally tied to just the size of our balance sheet.
So I want to talk about Sunwest, and in a minute we're going to get into also regulation, the need for it, because so many of these banks have misbehaved with their managing risk, if you will. But just quickly, an average spread, a healthy bank should generate a spread of what? Cost of capital versus what they're generating on their income.
When you think of spread, it will depend and kind of the makeup of a bank's business. But most of the big banks or consumer-oriented banks will operate with, call it a 2 to 2.5% margin.
Okay.
For Sunwest, where we don't play in the consumer space, that's really a scale game. We're experts in the business, small, medium-sized business, real estate developers, other different niches. Our margin, our spread will be typically in the 3.75 to 4.5 range.
So let's talk about that, because you are privately owned. Let's get into Sunwest Bank. So were they always private?
No. It was started by a small group of businessmen in Tustin back in 1969. They opened their doors in 1970. They were eventually bought by a holding company that owned a couple banks that was created by a couple real estate syndicators here in Southern California. The bank got in serious trouble in the early mid-90s. If you think of it, if you go back to the late 80s, early 90s, the economy in the U.S. experienced a great rolling real estate and financial service depression. Started in Texas after the tax law changes of '87, and started rolling through America. Hit Texas first, went to the northeast coast, came down the east coast, touched the Midwest, and hit California last. Most of the country was in that, probably in the worst spot in 89, 90, 91. California was bucking the trend, but then by 92, it went in very hard. So I, at that point, had already made several investments in other community banks, taking control positions in Southern California. And I was interested in not SunWest, but the other bank that the holding company owned, which was up in Sacramento. So I started discussions with the CFO of the holding company. I ended up buying their stake in their bank up in Sacramento. They took that money, invested in SunWest, because SunWest was literally on the verge of failure. In the banking industry, there is a ranking system called the Camel Rating by regulators: capital, asset quality, management, earnings, and liquidity. It's your Camel Rating, and you're rated one to five, one being the best, five being the worst. And literally, SunWest had a 5 Camel Rating in totality, because they rank you on each one, but then they aggregate your score. And when you're a 5, it basically means you're getting ready to be taken over and put through receivership by the regulators. And at that time, you got to remember that rolling real estate and financial service depression wiped out 783 savings banks and 565 banks throughout the country. So, and almost every major developer in every major city went bankrupt or was on the verge of bankruptcy as well. So it was a very hard time for the banking industry. So I thought SunWest was going to fail. I was interested in their other bank. I bought that and ended up, working with that bank for a bit and then sold it. And I came back to deal with the CFO of SunWest, of the holding company for SunWest, and I think he was also the CFO of SunWest itself. And I started looking while I was waiting in the lobby for him at their financials, and I was looking at it, I was going, wow, with a bit of money, this bank could be saved. So after we're wrapping up, I said, would you guys be interested in a capital investment? He said, absolutely. So I ended up putting money into the bank. I took a 49% interest because they had a lot of net operating losses, NOLs. And if I went over 50%, it would trigger something called a G reorg, which would diminish the value of those NOLs. So I bought 49% interest. And then after a certain point in time, once the NOLs got all used up, I was able to go above that ownership interest. But I got involved. And the first thing was cleaning up a credit mess. They were already starting to do that, but getting rid of the bad credits, because again, when somebody doesn't make a payment on either an office building or a business, you got to go in there and collect that and take back the asset and restructure it or sell it. So cleaned it up, shrunk the bank a bit. It was a very small bank at that point in time, and then finally started to build the bank. At that point, to be honest with you, it was just one of many companies I was involved in. I had my hedge fund, I had my investment banking company, I had investments in multiple different banking organizations that I was turning around. But I always thought SunWest was in a great market in Orange County, and I thought there was a lot of upside. And so it grew slowly. We always kept ourselves very disciplined. I mentioned earlier, there's 2 cardinal sins of banking. Investing long or lending long while borrowing short, getting yourself mismatched. And the other one is you can't price bad credit high enough. So stay away from bad credit. So I always was very credit disciplined. Always kept our capital levels higher, our reserves. Banks have to always set aside reserves for those bad times when they come. So I always ran with higher reserve levels, higher liquidity levels, and higher capital levels. So that allowed us, when the great financial recession came, because I'd seen the housing bubble being formed. I was very involved with my hedge fund at that point. I was talking to policymakers, senators, congressmen in Washington, where my main companies were, because when I moved out of Madison after I graduated from college, I went to live in Washington, D.C. and that's where I started my first companies. So, I was seeing this getting ready, this housing collapse, and I knew the devastation it would have on the banking industry. And fortunately, because, we made our last residential construction loan in the summer of '05. And ironically, even that one bit us a little bit. But, I saw all these banks continue to lend through the end of '05, '06, '07. And man, were the repercussions huge. So we were able to go in at that point in time, and we bought 5 failed banks over a 5-year time frame. We went into Idaho, we went into Arizona, we went into the state of Washington, and we picked up a couple failed banks in California. At the same time, I also put together and rolled together several banks on the East Coast in the DC, Baltimore, Maryland market, and I think put together 4 different troubled and failed banks.
So so you bought a 5. I call that opportunity investing. You've probably today it's a 1, the Camel Rating. Is that fair?
Yes, we always are at the top of our Camel ratings.
And the Sunwest footprint, if you will, franchise footprint is multi-state?
Yes, we actually moved the headquarters 4 years ago out of California to Salt Lake. Look, California is a difficult market to do business in from a variety of different ways. California has wonderful aspects to it, great lifestyle, beautiful, all the rest, but very difficult to do business in. And we moved into Salt Lake and the Utah markets because we saw it as a very dynamic market, growing, very business friendly. We bought a failed bank up in Boise, Idaho. Love Boise, Idaho. We've moved a lot of our back office personnel up there. It's just a better lifestyle for people that operate in back office operations because, there's a pay schedule. And, trying to keep those people here in California, they would literally be driving 2 hours a day just one way to get to work. So we could find a more stable workforce up in Boise, so we've really built that out. We have operations in Arizona we bought a failed bank, and we've really grown that. And then we've moved into the west coast of Florida. So we pretty much are, the Rocky Mountain states, California, and the west coast of Florida. And we're a business bank, as I mentioned before.
Sure. Yeah. Excellent franchise here in Orange County, solid reputation, great employees. I've had some personal experience with the bank, and it's been wonderful. So thank you for the service you're providing and that overview. I think that's very helpful. So I think as we think about a bank, they're really investment platforms, if you will, though that are regulated much more so than many other investment and private investment platforms. So help us understand the latitude that banks have to make investments and the impact that the regulatory oversight plays on that latitude.
The banking industry is literally one of the most regulated industries there is in our economy. You would have to think maybe nuclear energy is right there, but I mean, banking is about as regulated as they come. And there's logic behind that because if you think of what happened during the Great Depression and the collapse of the banking industry, the bank runs. You think of what happened at the end of the 80s, early 90s, the great financial recession. Look, if the banking industry goes down, it really impacts the whole economy. Think of banks as gas stations. We provide, like a gas station provides, fuel to cars and trucks on the road, and the lower the price of gas and the more plentiful gas is, you'll see more cars and trucks moving up and down the highways. But if gas prices go higher or gas stations start closing, then you're going to see a lot less activities on the roads. Well, think of that. That's the corollary for banks to the economy. We provide the money, the loans, and the investments to the economy. And that's where the Federal Reserve can expand the money supply largely through the banking system into the economy. So it's a critical intermediary between the Federal Reserve and to the rest of the economy. So for banking, we're very regulated. I will tell you now, we're massively over-regulated. And the problem with that is it's killing a lot of the smaller banks out there, which is not good, because one of the reasons the U.S. economy is so much more dynamic and more entrepreneurial is because of all our community banks. Because small businesses, when they first are starting off, aren't going to J.P. Morgan or Bank of America. Trying to get a loan from them for a startup business or a very small business is very difficult. They generally get their financing from a local community bank that will work with them, get to know their business, and help them grow. So banking is critical to the economy. Community banking is critical to entrepreneurialism and the startup of small businesses. But it is a very regulated industry, and I would say now massively overregulated. But, as I said, there's a certain amount of regulations you definitely need. I just think the pendulum has gone way too far.
Yeah, so you talk about the pendulum. There's been some bad actors in play, and you obviously are very astute. You have a deep history of banking and investing, and you're probably the exception rather than the rule of the banking performer, if you will, bank owner. So I understand that the excessive regulation is now limiting what some of these banks can do. So educate us about maybe Dodd-Frank, Basel III, a little bit of the regulation, and what exactly are they doing to cause those smaller banks to in essence, not be able to do what they need to do?
Well, Dodd-Frank had one fundamental problem, and that was creating the concept of too big to fail, and where it's almost basically backstopping of saying the biggest banks that they will have a mechanism to deal with them and bail them out, because if a big bank collapses, it can have such huge ramifications to the economy as a whole. But when you do that and you say one party's too big to fail, then you cause distortions in the market. And like when Silicon Valley went down, all you saw is suddenly see people move their money to a J.P. Morgan or a Bank of America because, they're too big to fail. So it messes up how our free market system works. Frankly, I think one of the problems during the Great Financial Recession was that they didn't hold a lot of the big investment banks and some of the bigger banks more accountable and make it more punitive when the government bailed them out, which was, in my view, wrong. So you cause distortions. But on top of that, it just swamped the industry with thousands of more regulations. And if you're a smaller bank, you don't have the scale to carry the cost of all those new regulations. So that's where it starts beating down. We're at a size where we can manage through that. We're $3.5 billion. But if you're a $500 million or $1 billion and below community bank, you just literally can't keep up with all the regulations and put the bodies to work. So it allows the bigger to get even bigger. And I think that creates more risk for the economy, because then J.P. Morgan, B of A become even bigger players and put more risk if something goes wrong with them. So again, I think it causes distortions that aren't healthy for our economy over the long run. And I'm concerned that it will continue to shrink the smaller community banks that are such a vital part of the entrepreneurial climate and the small business community.
Well articulated. It's a perfect entree to what you talked about earlier, GFC and the consolidation of banks. As I think about it, I'm going to guess 14, 15,000 banks in 2007, 8 during the GFC. Today, there's maybe 4,000 banks. So is this consolidation going to continue? Do we have too many banks in our country? Where does this end as you think about, and what's the benefits to that consolidation or not?
Look, there's going to continue to be consolidation, and frankly, some of the small banks will disappear because they're not well managed, and they don't have the scale. But again, you want you want new startup banks. You want to keep a healthy amount of smaller banks. Probably the biggest part of consolidation that you'll see are some of the bigger regional and super regionals as they're trying to match up against the B of A's and JP Morgans. Uh, but the one problem when these banks get too big, they really become less dynamic and less flexible, and you're seeing big problems with the big banks. And anybody that's gone out of a bank like SunWest that goes and deals with a JP Morgan or a B of A or Wells will tell you horror stories trying to get decision making. I called it I wrote about this in 2000. I called it the Walmartization of banking. And what did I mean by that? You were seeing the banking industry the bigger banks trying to become Walmart, where they were going to operate in every market and provide every financial service and share of wallet, and have every single financial product locked up to that customer. Well, that works when you're dealing with consumer lending, because, with auto loans, you can use blue book values. With single family mortgages, appraised values, credit cards, you can use FICO scores. It's very easy to box that credit risk. And you're just creating big platforms and scale to provide that service. The problem is when you go to that model, it really doesn't work for small and medium sized businesses because each business is uniquely different. And it's hard to fit a more boutique, specialized model in these giant platforms. And that's exactly what's happened. You've seen it across the board. Uh, so many of the small, medium-sized businesses have exited Wells and B of A because they can't get decisions. Credit decisions go up multi-different ladders. The quickness of decisions is hard. And then you will have at certain times, a B of A or Wells will just say, we're out of this market, and they will exit whole areas, or we're just going to shut down, commercial real estate lending like a lot of them did in the summer of 22 and good parts of 23. And all of a sudden, they're just out. And then you had examples like during, the lockdowns and the introduction of the PPP loans, where Wells Fargo said they were going to do it, then they're not going to do it, then they're going to only do it for certain parties, and then they're not, and just enraged their whole clientele. So they're just not very nimble companies. And so it's really hard for small and medium-sized businesses to last in those platforms. So we've seen a huge benefit. We love competing against the biggest banks. Absolutely love it. We can provide better services. Decision makers they can talk to any of the decision makers in our company. We work with them. We get to know them.
You've explained well while there will be consolidation, but we have to manage that to a point where, SunWest for sure differentiated itself with just the service you can provide. I think many of our listeners were First Republic Bank customers and used to enjoy their extra service. Unfortunately, they mismanaged their book, but it's an example of things we need to be watching for as we watch this consolidation and push regulation. With all this, what's happened is private credit has seen a boon, and private credit has taken off in many ways in concert with banks, as banks provide credit to many of those private credit performers. So, what's your views on private credit? Good thing, bad thing? Is it going to go too far? How do you kind of reconcile that, if you will?
Look, private credit has grown bigger and bigger ever since the great financial recession because of the restrictions put on to the banking industry and making many of the banks less flexible and entrepreneurial, or however you want to define it. So I think private credit has a very important role. In saying that, I think the industry is overexpanded. And I think when we get into the next recession, there's going to be a lot of problems with private credit, because typically private credit has to go take greater credit risk than a bank, because the funding costs of a bank are much lower than what the funding costs for those that are allocating private credit. So there's only so many players that can do that right and well and understand the underlying, and most of it's done in real estate lending. There's a lot of it in the business world, business lending too, but the bigger chunk is in the commercial real estate lending world. So there's only a certain amount of people that really have that expertise, but they have to go stretch either with the borrower or with the loan to value or the debt service coverage ratios, whatever, because I can price things always better than private credit for a great deal, because my funding cost is 300, 400, 500 basis points less.
Sure.
Either they're funded, private credit is funded with equity where people are desiring a higher return, and or with bank lines and wholesale lines, and we do that for certain private credit operators. But we're charging them at least 400 basis points more than our funding costs. So I think private credit's going to continue to play a very important role. I think there will be a contraction. There will be some losses that come out of it when we get into the next downturn, which I think is coming very rapidly. I think we may already be in the beginnings of a recession, but it'll be interesting to see how that plays out. But it will always have its role.
Eric, great summary on private credit. Don't disagree with you. And I want to turn a little bit now to, lots of ways to give back. And I think about some of your passions and your education here today, and giving back to this podcast, to these listeners, about financial literacy and understanding of banks is a great example. But I'd be remiss if I didn't share with our listenership what something that you're prioritizing right now in your life, and that's running for the state Senate of Wisconsin and U.S. Senate, excuse me. And I don't want, our podcast is not a political platform, but I think it would be worthy for people to hear a little bit about how you really have viewed this as a way to give back, given the good fortunes you've had in your life. So talk a little bit about why you chose to run and what that means. And be appreciative of the fact that we're not a podcast for political platforms. So keep it kind of broad-based, if you don't mind.
Yeah, by all means. Look, because of certain beliefs, I believe too much has been given, much is expected. To where a man's heart goes, so goes his treasure. So charity and giving has always been a big part of my life. I created the Hovde Foundation a long time ago in the 90s, funding a variety of different things. I've created Hovde homes around the world that rescue abandoned children from the streets and provide care and shelter and skills training and most importantly, love, because, we're rescuing kids out of the sex trade, out of slavery. And we have 4 in Africa. In Ghana, we're rescuing kids out of slavery, and we got 5 in Central and South America. So, giving back to, those that are less fortunate is very important to me. But I share that so you understand my mentality and deciding to make this run for the U.S. Senate. As I said, look, I've had a blessed life. I've had a wonderful life. And over the last 3.5 years, I've been concerned about what's been going on in our country, honestly, for the last 15 years, leading up to the great financial recession, how we handled that, how certain groups on Wall Street got bailed out and, Main Street got left to die. And I've just become increasingly more concerned. And then over the last 3.5 years, I just can't believe what's happening to my country and the financial damage that we're doing. We've created more debt in the last 3.5 years than our country's first 230-year history. That's stunning. Our interest cost on this $35 trillion in debt now is bigger than our Defense Department budget. It's only a little bit less than what we spend on Social Security. And within 1 year's time, it will be larger than the cost of Social Security. We're bankrupting our kids and our grandchildren's future. I have deep concerns what we're doing financially. I'm concerned about our domestic security, be it with open borders, defund the police. I'm concerned about what's happening internationally. We haven't seen the globe, in this much chaos. You'd have to go back to the 60s, literally the late 60s, early 70s, to see the world with this kind of problems. And you look at the division in our country, we've become way too divided, way too polarized. As I like to say, we've got to stop putting on the blue jersey or the red jersey and competing against ourselves. We got to put on the red, white, and blue jersey and come together as Americans, because we have enormous challenges in this country that have built up over a long time. And we're seeing the consequences to our children and grandchildren. We've never had a younger generation in such crisis. Suicide rates, anxiety rates, depression rates. 77% of our young people cannot qualify for military service today because of mental health problems, drug addiction problems, and obesity. I mean, that is absolutely stunning. We're losing 100,000 Americans every year to fentanyl. It's the number one leading cause of death of 18 to 45-year-olds. I mean, that's a crisis. So, I decided, if I'm not, better people don't get involved in politics, that don't want to make a career out of it, just want to go serve. I believe, our country, if you read what our founders wanted, they wanted citizen legislators. They wanted people to view it as service, to go serve their country for a term or two, bring their expertise, not make it create this political class that they left Europe from, the kings and their entourages that ran everything. I believe we need to get back to that concept of citizen legislators, people that are doing it as a form of service to help their country. And I'm very patriotic. I've been blessed. I've lived this American dream. Robert, you've lived this American dream. We're such a special country, and I've been in 100 countries around the world, and I can't tell you how important this country is. And if we lose this country, the world is going to be in a lot worse spot, and we're going to be in a lot worse spot. So it's worth fighting for. So I made the decision to get into this ugly thing called politics. Man, it's ugly. As bad as you think it is, you can multiply it by 10 and maybe you'll get there.
Well, I want to personally just thank you for your initiative in this and the difference maker that you are, and hopefully will continue to be. I appreciate, just for everybody's knowledge, how much is this your full-time job right now? Obviously, you got a great team at the bank and with your other businesses, but this is where you spend all your time now, right?
This is where I spend all my time. All my time is wrapped up in this. I literally go from morning to night on weekends. I am going nonstop. Now, it's interesting. I have experiences in one day, multiple experiences most people will never have in their life. There's a fun piece of it. There's an ugly piece of it. Fortunately, I was blessed with a lot of energy and very thick skin. Those bode well when you're in this thing, because you got to have a lot of energy. You're running a marathon distance at a sprinter's pace, while people are throwing arrows at you.
Sure. Well, I would bet on you. I would ask, as we kind of look to close down our session today, look at what you're doing, look at what you've done. How do you stay balanced? Just some of your personal passions. How do you stay sane amongst all those arrows being shot at you, as you expressed?
Yeah. Well, look, I've always lived with a lot of stress with all my different companies and all the rest. My real estate development company, always under stress. So, a few different ways. I live an exceptionally healthy lifestyle. I've had MS since 1991, so I really live, forged, knock on wood, while I had hard times with my MS. When I was back in my 30s, all in all, it's been very good. But I live a very clean, healthy lifestyle. I exercise an hour to an hour and a half, maybe 2 hours every single morning. I find time. I start my morning, in prayer, and you got to find those moments. And nature, to me, I'm not good at meditation, but for me, walking through the woods, being out on the lakes in Wisconsin, paddleboarding or water skiing, that to me is where, I find my peace and let my stress levels come down and all the rest. And then obviously having wonderful friendships and family, my wife, my children, and I've been blessed with a lot of friends. And life is meant to be lived with others. And so I've been very fortunate in that regard.
So as we wrap, you've been a teacher par excellence today, and I can't thank you enough. I'm sure a lot of people understand much better the banking world today. What advice might you give to a young person who's maybe thinking about building a career in today's financial industries as they, chart out on their path?
Look, I like the financial service industry. I like banking. I've been involved in a variety of other companies that we didn't touch. But banking, because of the complexity of it, is very intellectually challenging. So I like that. But, my big advice to young people is work your butt off in your 20s and 30s, because you don't want to be having to struggle and work your butt off in your 50s and 60s. Take your risk early in life, because it's a lot harder when you get, later in life and you get married and you have children. It's a lot harder to take those big risks. When you're first starting off, explore a lot of different industries. Figure out what you really pulls you and motivates you, because whatever you align with and have passion around, you're going to do better at. So, when you're in your 20s and early mid 30s, explore, learn as much as possible, take your risk and work hard. The financial service industry is a great industry. As I said, it's a lot more complex than most industries, and I've known a lot of people that have built great careers.
Eric, I can't thank you enough. You did not disappoint. Our Counting Capital podcast is going to be that much better because of the contributions that people like yourself make. My takeaways are many, as I've kind of made some notes here. But as I think about you, your clear and direct communication certainly will serve you well in your current endeavors as you charge ahead on that front. But I think a good message for the people listening about that, the importance of communication, the purposeful way that you've built your career obviously has benefited you when you've made that final set of investments with owning a bank and expanding the bank and building that franchise out. I love work your butt off. If that's not a take-home value for everybody and for the young people, what else is there? And you and I share that passion. So, but at the end of the day, what I really most liked was red, white, and blue. That's a great uniform. That's a uniform we can all wear. So thank you for that message, and I appreciate you and appreciate your time today. So I look forward to having you back one of these days.
Thanks, Robert.
Thank you for joining us for our Counting Capital podcast with Eric Hovde. We'll look forward to having you on our next episode. Thank you very much.
Thank you for joining us on this episode of the Counting Capital podcast. For informational purposes only, and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.